Hello and welcome everybody to MoreTalk. It is 2 p.m. here on the East Coast, and this is usually when Michael Zhao will be saying 11 a.m. on the West Coast, but he is taking continuing education in the multifamily business track at the MBA, so he'll be joining later in the hour with Bill Dallas. We will be starting out as soon as Chrissi Rhea joins me. While she does, some quick housekeeping. Today's show is sponsored by Velix Valuations. They are an appraisal firm. And right now we are meeting with people to really explain the supply chain of where it goes from an order all the way down to the appraiser that goes to the door. These are meetings I've been setting up and really learning a lot. And also Silverwork Solutions, if you're not aware of, just working with Chrissi here and getting in. If you're not aware of the Silverwork solution, it's a persona-based bot. I have never seen anything like it, and I'm having a lot of fun introducing it to people. On today's show, we will be going over with Chrissi Rhea, who is an owner of an IMB, number one in Tennessee in many different products, USDA, as well as down payment assistance programs there in Tennessee. And we are going to be going over her journey here as soon as she joins us. And it's really cool because our second guest, Bill Dallas, very famous in the industry for what he has done. And I've been able to watch a couple of the podcasts and shows that he has been on and really learn how to hopefully take this conversation today further than some of those. And then I look over at Chrissi, and she's done so much for the NBA, but as far as how many interviews are on YouTube, not that many. So this is going to be a special time, and here she is here. So, Chrissi, I'll let you unmute yourself, and sometimes here you might have to do something with the Chrome or the Safari browser on the unmute.
Yeah.
Allow it. There you Perfect. So I was given a little bit of an idea of the show. This is a live taping, so we do it every Thursday at 2 p.m. so that people can raise their hand and participate. But it ultimately will be on Spotify, and it will be on the Google podcast is where we do it for. And this one's a story about 1989, West Knoxville, right? Two people with a vision of a future about helping homeowners get into homes. One person was named Chuck Tonkin III, and the other person I met at a MoreTalk dinner that I was invited to, one of the very few vendors in the room, and just a serendipitous circumstance where I was next to Sean Black, wasn't even aware. He was nice enough to talk to me. We sit at the table, didn't realize he was sponsoring the whole thing. And then I felt bad as somebody sponsoring it. You should really be talking to other lenders and not me the whole time. So I turned to my right. There you are. We're having a great conversation, but I think really where we bonded, I always love this part of the story. The person to your right obviously is speaking with you and then asks you what fish you recommend. And that's when you said, if you're looking for fish at Del Frisco's, I think you're in the wrong spot. And then I think you turned back to me and said, so what are you up to again? So I think that was always a funny story for me.
Yeah, no, a nice evening too.
It was. I guess before we begin on the journey to get to there at MoreTalk, is that usually something that takes a little bit of time for leaders in the industry to really understand? Like, as you watch others, it doesn't happen overnight. How does somebody get from, running in an industry and being in a lot of the articles on National Mortgage News, Housing Wire, to finally starting to show up at those MoreTalk events?
Yeah, no, I think it's very easy to get involved. MBA does a fantastic job at providing information on what the agenda items are for the MBA that we need help with. So no, I've been a big fan of Mortgage Action Alliance group. Gosh, 10 years, I guess. I've been a little more active in the last 6 or 7, but no, it's a wonderful way for all of us participants in our industry to get involved and give back to our different communities. I hate to say it, but it's about the easiest thing in the world to send a letter through the MBA. They'll send you a link and you push this little button and you say, this is my home address. And it sends all of the emails of whatever your agenda item is to your legislative party, members in your particular area. So it's a fantastic way. I highly recommend MBA and certainly MoreTalk. And everybody can join the Mortgage Action Alliance for free. And you get constant updates on our industry and the things that are important to us. One that's really close to my heart is trigger fees. So yeah, on and on about that one. So I'll give it back to you, Michael.
Well, why do you think it's so hard? The leaders of these lenders are filling out the Mortgage Action Alliance buttons, but the employees are not doing it at the masses maybe needed. Now, I've seen that effort change over time, but why do you think it's so hard to get that top-down approach when it comes to that particular piece of advocacy when they've made it easier and easier?
Yeah, it should not be difficult. I think my staff is just fantastic at participating. We talk about it. We talk about what the action items are and why it means as much to the processor as it does the underwriter, as it does the loan officer. It's our industry, and it's the profession we've chosen, and to keep us safe, to keep us protected, to be able to be sure that we have the representation that we need in DC. This is just a wonderful way to do it. And it shouldn't just be the CEOs or, the upper management. It should absolutely be the entire staff. And it's easy. It's not hard.
No, but I think, every company has different cultures that they're building as well. Yours, when I looked at it, it's very almost family-like, right? And I think maybe that was more common, but it's obviously changing now with the social media world and trying to attract loan officers. With you and Bill, you both started with small companies and grew them into large ones. I think you started with 7 employees in 1989.
Right.
What are some of the hard milestones of growing when it comes to employee count? Is it like, where are the hard parts to go from like 10 to 20 or 50 to 100?
No, I would say more of that 50 to 150. When all your company is completely changed when you do that, when you go over the 100 employee mark. We did that probably, gosh, I wish I was better at this. My partner certainly could tell you the exact date we went over 100, but that's not kind of what I do. But I'd say it was, mid-90s, I guess. And we changed company things. We became a true lender. We got our own warehouse lines. We pursued our own investors. We had first our Freddie approval, and gosh, I guess in less than a year, I got the Fannie approval, and we felt like real grown-ups. So that was probably the biggest move, being the company with 7 employees as a broker, to moving us into a true environment that we were actually the lender and taking the risk and participating in that too. So I would say it was when we finally grew up enough to take the risk and use our own money.
And that's, we hope that certain loan officers, processors, whoever it may be, listen to our more raw podcast and understand that there is an environment at the national scene, at the MBA, that if you have the resources, and Bill said it in one of his that we'll get to later, his podcast, Victor from GR, Chris George from CMG, you guys, like, we're all brokers, and now have these larger companies. So there's no reason somebody now that's a broker of a 7-person shop can't be a top 100 HMDA lender 15 years from now, right? Yeah. Do you think it's, how has the pathway changed when it's come to like warehouse lines, Fannie, Freddie, those type of things that you're saying? Is it easier to acquire those nowadays, or do you still is it better to do it organically like you guys did?
I think it's always good to start a company if you're very small, like we were, with 7 employees. Our goal was to be become the number one lender in Knoxville. And so we had our visions very specific, and we had our goals very specific, so that when we saw the opportunity for growth, we were ready for it. And then being able to move into that next level with warehouse lines, with underwriters. We hired our first underwriter, and we did our full Eagle DE, and we thought, okay, we've got this. And then really and truly, what was probably the most difficult transition, but very important for us, was technology. We talk about it today. The growth in the technology in the 90s was pretty incredible. We started the company, Chuck and I started the company, 7 employees, and we had typewriters. We had a fax machine too. That was our big claim to fame. When we decided to get our first LOS was around the time that Freddie Mac was beginning to roll out Loan Prospector. And so we wanted to be prepared for that. We think we were the first company in Knoxville to run automation, to run automatic underwriting. So I remember the ads very well. It's like Mortgage Efficiency Group is leading lender in technology. Well, it was DU, and LP. But to me, the growth and the anticipation of what happened in the 90s with just introducing technology in such a short period of time, where all of a sudden the underwriter is going, oh my God, I'm going to lose my job. And the loan officers are going, I will be useless in a couple of years. Oh my gosh, technology is going to replace us. So it was important as leaders of the company to assure everyone that no, technology is going to be your partner. It's not going to be replaced.
And ironically, back then, technology now gets introduced with these big parties at conferences and LinkedIn, right? And
yeah,
back then, I'm guessing, at least during the typewriter days, are they giving you release notes via like manila envelopes in the mail saying, if you want to do this or fly out here? Like how different is it that the communication was such old school, but they're trying to introduce new school technology? Like, are they mailing you a manual on how to run LP?
Honestly, it was, okay, I'm going to go to every conference I can attend, be there in person and really understand it. We were fortunate to have 3 hours away in Atlanta, had a big seminar that Freddie Mac put on. And so, yeah, it was that, or mail us the manila folder to figure it out. So yeah, we certainly were not quite in the dark ages back then, Michael. It was 1993. I think LP came out in 96. So I could be wrong. So yeah, it required a little more driving, and
you still had to mail stuff, right? Back then.
Yeah.
And credit reports were, at that point, are they on the tear sheet still?
When we started the company, we would get reams of paper pouring out. That was your credit report. Probably in the 90s, it was improving a little bit. You could get it via fax machine. Also, it wasn't I don't remember what kind of paper that was that we originally had, but you had to tear it off and pull it out. Probably the biggest difference is credit reports took a week or two to get back. It's kind of, if you think back, they didn't have technology either. A kind of a fun story, speaking of technology, that I experienced personally. It was very early in the 90s, and as a broker, we were having other companies underwrite for us, whoever the investor was. And we had to mail those packages. We had to overnight them. Finally received the approval. I think that did come over on the fax. And this investor had a very important condition that they wanted to receive before they would allow it to close. So I'm like, oh my God, what am I going to do? It had to close at 9 a.m. And they said, well, we'd look at it right away, but they wouldn't even get it tomorrow until 10. So someone said, why don't you zap it? And I said, what the hell is zapping? turns out that that FedEx had a system that actually was really a fax machine, but somehow they zapped it and sent it on to the investor. They were able to receive it right away. That's kind of a fun story of telling us, now we're getting all borrower source data to us in 2 seconds rather than credit reports back then in 2 weeks.
I went out a little bit there. I don't know if you guys could tell, but my question would be, like, you now employ 400 people. You're the THDA top lender. You are Tennessee's leading USDA lender. Every year since 2014, over $23 billion served, more than 150,000 clients. Yet when I look online, like, MIG isn't flaunting the Cabo trips or the big woo. Your videos look very organic, family event, almost like what you would see like in a large gala or wedding, large tents,
Yeah.
How, I'm sure this is on purpose, like, how has that environment served you? And do you feel any pressure with, like, seeing these Instagram drone type things out there? How are you able to keep from being distracted and keep your culture the way it's always been?
That's been pretty easy. And I think it's because we have surrounded ourselves with just absolutely phenomenal people, not just our loan officers, but everybody is part of the company. Even as we have grown, I believe strongly that our mission of our mission of keeping the culture of our family environment and worrying about whether we can retain it, we were able to do it. We're really also very fortunate to have a fantastic marketing department. And so they know my mission. They know it. I don't want this flashy, crazy stuff. I want them to see who we are. We're hardworking people and we love working together. We love celebrating our successes. We love celebrating our referral partners and appreciate them so much. And that's the message that we want to get across.
That's incredible, Chrissi. It's great to be back on the show. You've done an incredible job of leading your company. I mean, it's rare for any IMB right now to have an incredible amount of USDA loans, and for the fact that you can have incredible success in Tennessee across the board. Is there a possibility of further expansion? You have an incredible way of doing business already. Is there plans for expansion to take your vision and to take your type of entrepreneurship from MIG back into the Midwest and to the West Coast?
When we look at our expansion, we look at our growth, and absolutely, I believe strongly that if a company is not growing, it's going backwards. So we of course, looking to expand to other fund markets. We're a great Southern lender. That is our forte. Not so much the people and not being able to keep our culture if we went to other Midwest states, for example, or Northeast. But at this point, we don't have the resources to know the property values that occur in those areas. So it would be a wonderful find for me to be able to, either purchase someone or a group or a branch, because I would want to rely on their expertise rather than trying to say, we've got this. We've been in Knoxville or Tennessee, and we've been in, certainly Georgia and Atlanta market, and we're rocking and rolling here. That doesn't mean we know Missouri. That doesn't mean, we might know Missouri. It's very similar, but we wouldn't necessarily know Kansas. So we rely very heavily. But yeah, the answer is, how fun it would be to expand what we have, what we've grown, but who we are, and take it to other markets.
Where do you think other companies have kind of maybe flew too close to the sun on expansion? Like, is it trying to get a state for the sake of a state and not looking at the right? I mean, obviously, people right now are expanding while losing money. It's an interesting strategy. What are your thoughts on that strategy?
I think everyone in our business should be doing what they do best until this market does improve a little bit. we've certainly continued to hire loan officers and loan officer assistants because we think it's important. However, we're very cautious at hiring anyone right now. It's a big thing we've always done in the past of hiring people that are inexperienced and us training them. But at this juncture with this mortgage industry, I believe very, very strongly that companies should be hiring, certainly continuing to hire, but not paying the huge sign-on bonuses, not trying to go into other markets that is going to cost you a fortune to figure out how to originate in those areas. And certainly be very cautious about bringing on new people who have not been in the business. I mean, that someday, and it may be May, because they would be, a true find. So yeah, no, we love expanding. We love moving. We love moving forward. We love bringing on, especially obviously who doesn't experience loan officers who meet our culture. We've had a few that we hadn't hired because it's like, that one probably is never going to be happy at mortgage investors. We could then make all of our lives miserable, kind of. But we anticipate really probably pushing forward a little more in May, June, July. Unless the opportunity comes around, that's what we always say. Oh no, we're not going to do that. Well, unless it comes around.
I love how to stay in your lane. And I'm in California and I see all kinds of originators because of the slowdown of business trying to go to other states. And I just wish that more originators would learn to actually do what you're doing. Know your area. You don't need to go into your area that you don't know. Stay in your lane. Do what you do best and be profitable in the area that you know. Be profitable in what you need to do. That's an incredible lesson, not only as an originator, but also for other IMBs and business owners as well. I just love that you have that.
When we started in just Knoxville, our goal was to look, what can we do better than anyone else in this city? And it was like, we could be the star FHA, because remember in 1980, some of you probably weren't even born in 1989, but in 1989, 90, 91, realtors really wanted to stay away from FHA because it was so labor intensive in their mind. There was so much paperwork and, those appraisers beat us up on our property. Yeah, not really. So we decided we would become the expert on FHA. And we were able to, I think we had a 40% FHA market share in Knoxville in those times, because if we stayed in our lane, just like you said, Michael, and we said, let's be the expert somewhere. Well, everybody's an expert on conventional loans, so let's jump out there and be the expert on those. So that really played well in our market because Tennessee, but it allowed us to expand through the state.
I love the old school stories. What stuck out to me is many people in this industry get to where they are through sales. So when they're looking to expand, they look at a loan officer. Okay, can they sell? Always talking to you, anytime we've spoken, you've said, Michael, I'm really a product person. I know how to build a product set. And you're sort of speaking it there as well. And Bill Dallas, who will be on later, also talks about, I think as the GSEs have really become who they are, there's a lot of he speaks that, you're all selling to the three same spots unless you can come up with product outside of that and differentiate yourself. I guess if you could talk about that, but how do you go about building a new product, and what should some novice person listening understand that why it is so difficult to build or take ownership of a new mortgage product that's a little bit different?
Well, we are firm believers, just like we did in the 90s, that you have to be the expert. Everybody knows how to do a 30-year fix. So what can you do different? Well, you need to know your market better. You need to know what the challenges are with the real estate or the appraisal market, and really be the one that counsels your borrowers to help them through this, to be your referral partners, your realtors, real counsel as an attorney, but just understanding our industry. All of us, and every loan officer I've ever met hears of these different products. And I did the same thing when I originated. It's like, oh my gosh, I could answer my prayers if I could only have those weird products. Well, the reason those weird products are so difficult is we roll them out. Let's say, we could refer to the 2004, 5, and 6, the stated income. Yeah, nobody became an expert. You threw it up against the wall and it worked. Well, then it failed miserably and caused everybody pain. Well, then we went to, Dodd-Frank, and we were all very safe. And we took those kind of yucky things away. But then we go, okay, but the loan officers we have to have different products just in case one comes around. Well, they don't come around, at least in our Tennessee Southeast market, as often as our 30-year fix. So if a loan officer becomes an expert on a DSCR program, for instance, they may not see another one for 6 weeks. Well, your expertise kind of went out the window. So you really have to refresh. So you get stuck in little things, and then everybody's mad, and they push the underwriters, over the bridge. And that's why they're so difficult. What we have found to be fairly successful in a lot of our specialty product is to have a referral system plan so that we have several experts. For instance, reverse mortgages. It's just impossible to originate to really become the helper and the guidance for an elderly person if you're only doing one every 8 months. What we did for that product and others is to have someone within the company, or 2 or 3, that are the experts, so that our loan officers could say, you know what, pay me an 8 and you can have the loan. I want to stay in contact with the realtor, or I want to stay in contact with the buyer also, but you take this and run. So that's really been, I think, a huge advantage to a company. Is really a 30-year fixed rate lender, not to get yourself like crosswise in big hot water. And still have
that makes total sense. And guess what? You are captivating so much. For those listening on Spotify and YouTube podcast, please give us a subscribe. We do it for you. We try to be different than every other podcast you hear out there. And we are going to eventually, we set out to be consistent, Michael and I, and we haven't missed one since June, but you can come on Thursdays at 2 p.m. Eastern, 11 a.m. Pacific on LinkedIn Audio and actually participate like a radio show, call in. And so we do have someone calling in to ask a question. Matt Montoya, sort of in radio format. Do you have a question for Chrissi here that you'd like her to answer, or a comment? Or did you just sit on your phone and end up on?
You know what? I thought when I unmuted myself with my headset that I unmuted myself on LinkedIn as well. I apologize that didn't work as I expected it to. So I wanted to touch on one of the things that you were covering there. First of all, Bill Dallas is not on yet, but I've never met him, but I have worked for a few of his companies, and just wanted to say thank you, Bill, for some of the opportunities you've afforded me in the past. I have worked as an Encompass admin in the mortgage industry for a long time. But I did, as you said, Michael, start out in sales for a subprime lender a long time ago, and I worked my way through compliance into the tech side and everything else. With that being stated, I have also worked for what are called business purpose lenders. And a big focus of what they do is they focus on business purpose lending, meaning fix and flips or commercial they kind of dabble in commercial multifamily, but they also dabble in traditional mortgage. Just it's non-owner occupied, so TRID doesn't apply. So it's a little bit of an easier market, and you have somebody who should be a little more educated in terms of who you're lending to, so you don't necessarily have to worry about those disclosures, etc. So with that being said, you were talking about DSCR loans, and that's a more regulated version of some of those business purpose loans. Have you ever considered taking a look at some of those opportunities on the business purpose side, such as, like, I believe Bill Dallas has a large stake in Civic, so he can talk about this more than I can. But something like what Civic's business model is, being able to incorporate that into what you do and being able to give those loan officers who want to learn and become more of an expert on DSCR and some of these other niche products that can give you another form of income, because a lot of those loans are quick 60, 90, 120 day loans. And then it's almost like in insurance, when you get that renewal, the loans just keep coming back. And I'll go ahead and shut up now.
Yeah, no, Matt, thank you for that. I think that those, and I may be wrong, but they are very specific to particular markets. Going back to the stated income, when we all knew Countrywide were selling a lot of stated income products to them, and it cost a quarter. So in Tennessee, you has 90% employed by either a university or the government or small business, and they get W-2. So we'd say, our loan officers would say, if you don't want to give me your W-2, I can charge you a quarter. And they go, what? I just didn't give you, the W-2 instead of the quarter. So I think it doesn't go as well. Those fund business purpose loans may be in East Tennessee or Middle Tennessee or Southeast. But what piques my interest, and thank you for bringing it up, and I can't wait to talk to Bill about it, is the fact that you could have a different arena. Instead of your 30-year fixed rate experts on purchase business, you could develop potentially a channel or a department that would focus on business purpose loans. And I love that idea. What a great idea. Thank you. With our, sometimes absolutely the top producers in Tennessee and the Southeast, they do that pretty darn well. I'd hate to pull away from what we do well, but I love the idea of adding it to our whole platform.
A question I always have, I'd love your take on, Chrissi, is understanding, just to like a 4-year-old, servicing, maybe one of our listeners out there that's a loan officer, a real estate agent that just doesn't get it. Can you explain how lenders decide, as they grow, when they're going to actually service the loan? Because that's the weird part about mortgages. Loan officers want to be this consultant, financial advisor. Bill Dallas says it well, I think, with like an equity advisor. But then you have all this like capped up equity now in this country, and very few loan officers work with it. They've moved on to the next transaction, and then maybe their company doesn't actually service the loans. So can you explain just servicing a little bit and your view on that whole kind of conundrum?
Well, we do service, and we have a very small portfolio. And I'll tell you, when we started, back when it wasn't, the value of servicing dropped so dramatically, we could almost retain the servicing for the exact price we were getting servicing release. So that was a great time. And really what we did, we said, what, if nothing else, we'll put breadcrumbs down so that if we get into this kind of market again, we can go, heck, we'll retain all the servicing. Obviously, servicing is and can be a great growth potential and asset builder for any IMB. More importantly, because the size of the company, we have experts in every department. Do you really want to build a whole department for servicing when you are going to go in and out of that market? So what we did was get a great sub-servicer. So we're able to strip off the whole loan, sell that to Fannie, and then retain the servicing. And obviously, there's many, many different times that you have to do that because of need versus want, but at least we have that potential. I can't say that we're going to all of a sudden decide to retain all of our servicing going forward, but if the market turns again so that the servicing value is nothing, why not? Why not build that asset, that long-term asset? I'm certainly a believer in IMB servicing. And quite frankly, for all IMB listening, the MBA is doing a fantastic job protecting us all and helping us. And Jenny Mae really went through, I guess, a period that they really weren't crazy about non-depositories servicing. So the MBA helped all of us in the group to get Jetty May. For example, IMBs are the number one opportunity, or could be the best opportunity for Jenny to really support their servicing and their own mission statement. Because we care a lot more. Not saying a word that the banks don't care about really one-on-one with their customers, but an IMB is known for that. Servicing is certainly something we should all in our business be paying close attention to always, and just for the opportunity to arise.
I think that's so important, just being connected there. You get somebody into a home, and if you're the one servicing it, maybe it allows it to be easier for a long-term relationship with that consumer. What do you think of the migration of like broker to IMB and back? I mean, obviously a lot, like there was an over movement because the brokers were really blamed in the public, right? Like right after the crash, I think they had 50% market share. They went down to 6%. They're at about 26%. Is that always going to go back and forth like a pendulum?
It really does depend on what's driving that market and why there are so many brokers versus independents. A lot of it has to do with what's the market look like for a warehouse line. You cannot be a lender unless you have the wherewithal and the ability to retain your assets or your profits yearly, so that you build your network. When we transitioned from broker to lender, really the number one reason I would look at it is because all of a sudden the world changed and said, oh, and you brokers have to disclose how much you're making on the loan. Lenders don't have to, but brokers do have to. And that's a hard sell. That's hard to understand. So that probably played a big part during changes in Dodd-Frank. And for anyone that was still a broker, they may have said, I am definitely going to do what I can to move forward to IMB market.
Chrissi, as a part of the business culture, and I'm going to relate back to our conversation from about 15 minutes ago, is there a way that instead of getting to the minutia, when you're out there either recruiting or looking to improve the profitability of each branch or P&L, is there a way to look at it and say, you know what, this is what's made me successful as an independent mortgage banker, and I want to make your branch more successful, your brand more successful, either in recruitment or in building? Is there a way to say, this is what I've done? Instead of focusing on the minutia of things, looking at the big picture, saying, we have focused on this. And I think that, do you have it as a part of your business strategy to do that, to encourage and uplift your branches or recruits to say, this is how we're going to uplift you. This is how we're going to support you. Don't focus on pricing, because if you do, that's going to be a price that's going to be something that every originator is going to do, and you're going to go down the wrong rabbit hole. Is something as a part of your business strategy to do that?
Michael, it certainly is. More importantly, we have an easy way, we think, and a lot of people have sliced this pie and have done a great job. It just hasn't been Mortgage Investors Group, because I haven't figured out how it is ever profitable in this environment. But that's the P&L branch, the old net branch. So to me, it really is black and white why we think our model works much better than a P&L. Every way I slice it, either the originator or the manager wants to have their own branch, make a lot of the profits, and they want to make 2.5 points. It's like, okay, so you want me to do all of the other services in corporate, but we only make 2.5 or 3 points. So where's the money? So guess what? You have to raise your rate, so your margin's 5 instead of 3.5. To me, that's kind of an easy, here it is on paper. Yeah, the world is wonderful. We'd all love to make. We really believe, and we're strong thinkers of this, that we need to share a lot of our revenue with our loan officers. Not share like a P&L branch or net branch, but just say, we're going to give you guys as much of the commission of our selling of the loan as we possibly can and still have money to run the company and to grow the company. So that's kind of our philosophy, really.
Yeah. I mentioned this to Eddie last week when he was on our show, and I said, it's so funny to me because the more production that you have, or the more you move up in your origination chain, the more units that you do, it just looks like that. Hey, on paper, you might be earning 125 basis points or 150 basis points or whatever you think you are earning. But then after you get down to the cost of things, you're at like 65 basis points or even 50 basis points.
I think the average for IMB is 25 to 60 basis points. We'd have to look at Mike Frantoni's fabulous models, but I don't think it's much more than that after everything is paid.
Well, that's what I was saying is that that it's the fallacy of being the mortgage broker thinking that you're going to be earning a whole bunch more when really you have more expenses. And going to retail, if you look at the numbers, once you're at a certain unit production, because nowadays you need to be able to produce units out there just to be profitable, not only as an IMB, but also as an originator, right? To a profitable IMB or a profitable unit is what I mean. And I'm just looking at that thinking the originators, they don't get it. All they're looking at is their bottom line. They're only looking at how many basis points am I earning. If they're only doing 4 units a month and I'm on the West Coast, 4 units is going to be profitable. But if you're in the Midwest with smaller loans, 4 units may not cut it.
The economy of scale, it's difficult to have a branch that does 4 loans.
Absolutely.
If we talk about that revenue piece, I think as an IMB or really any originating company has to look very closely at figuring out how to slice the pie. So for instance, when we were all making these crazy margins, we could pay because the margins were growing in 2021, for example. And even before that, they were more than they are today. And so it was kind of fair to say sharing and raising the loan officer's comp plan with, it made sense because everybody was averaging $1 million. Everybody was averaging maybe even more than that now. So that made sense to pay them 100 basis points, for example. Today, to pay someone 100 basis points for 2 loans that might be $500,000, 2 loans, and you're going to pay them $5,000, the economy of scale doesn't work. It costs you more to process that. So anyway, I think all of us lenders, IMBs, but also banks and depositories, I think we're all looking at the fact, what can we do to get our loan officers back to the $1 million because we can't afford to continue to pay the commissions when we love these guys and they do a fantastic job for their 2 loans.
I think you just touched on recency bias too, right? Like, so that's what we remember now, but you've been through it before. I know in 1980, there was a 20-year-old broker on Franklin Street in Santa Clara who was at law school and he was hedging his bets, and he started a company and watched the interest rates go from about 9 to 20%, kind of like now. Bill, if you were that student, what kind of class would you have for realtors to try and get any business in a raising rate environment?
Well, hopefully you can hear me, and Chrissi, you've done a great job.
Thank you, Bill.
It's great to catch up, and thanks for all you do with the IMBs and MBA, and it's been a long road, right? I think a couple observations, I think, for LOs and folks is clearly you don't need more LOs in these companies. You need LOs to do more, which I think is the headline. And I think my view of it is that when I started First Franklin, while I was going to law school, and was the goal was that I did real estate and mortgage. So I had a broker's license and I also did the loans, right? So and I think you see a lot of that, unbundling that was a challenge. And obviously you've got with Dodd-Frank and all the regulatory hurdles that you've got today, you see a little bit of a movement going back that way, I think. And I think with FHA, it's actually more I would say, regulatorily approved to do that. But at the end of the day, I think, the passion that I feel about real estate is the same passion that I felt about doing a home loan. I think it actually is the eighth wonder of the world for people. I think it has been for me. I sort of stumbled into it as I was hedging my bets, like you said, to go to law school. I didn't know if I would really like it. And I fell in love with it. And at that time, when rates doubled, it's a lot like today, because rates actually, the Richter scale back then was going from 8 or 9% to 18, which was a lot, and it shut off the market. People didn't have as much. People had a lot of equity in 79 and 80, and then that began to, as interest rates doubled, it just shut off the origination valve. You look at today, same thing, 3%, 2.5% during COVID, right? And then you trick up to like we are today to maybe 7 or 8%, shuts things down. So interest rates are one thing, and it does affect the market, and I think production. So you have to be a pro, first of all. You have to really understand your craft. You have to be highly trained. And the challenge is that, and I do think Chrissi's right, when you start looking at mortgage origination, you've got sort of the broker on the left, and then you've got this net branch thing to some extent on the right, and there's not much difference. While one actually wears the colors of the company, the other doesn't. And yet, at the same time, I'm a big proponent of the cost structure, because I would disagree with Chrissi a little bit. And I think margins are as high as they've ever been for conventional loans. And I got companies doing 103.5 to 105 in terms of their gross revenue, right? Especially if you're heavy FHA. But I see a cost structure that's higher than that. Abominable. I don't know what you think, Chrissi, but it's like, I don't know. I love what you guys have done, and we've been connected before for a long time.
Yep.
Stay in your niche, dominate an area that you're good at, understand the products and things that you do.
Yeah.
And I think the product, USDA is not an easy product. It's a hard one. You just have to do it really well.
Yeah, you have to be that. Do you see, and as IMBs, certainly probably more than the banks, because I don't think they moved as high as we did on compensation. But do you see an adjustment coming anytime soon? We spend a tremendous amount of time trying to streamline and be able to do more loans per FTE, per processor, per underwriter, per loan officer and their assistant. And do you see this in making that move to a different commission
structure? Yeah. So I'm going to approach it a little differently. I do think there's an adjustment coming. Yeah. I think the adjustment is more what's happened, at least my view with the companies that I consult with and work with, is that they buried all of this cost into fixed costs.
Yeah.
Right. So you've got an LOA, you've got I was just on the phone with a company, and they have to have, so let's just look at it, right? They're doing maybe 80 million a month, and they have, 150 LOs. They've got probably 90 support people. They've got LOAs running around. I think that the change that's happened from, I think the complexity of compliance has forced this truncation, what the loan officer does. So you have an LOA, a processor, a support person, a marketing coordinator, and somebody else, and all these people have salaries. Then you add a lease to it, and they are then adding profits. So my view is that you need the LO to come directly to the organization and be able to do the things the LO is supposed to do, and which is put the damn thing in the system and take a grade applicant. And if they do that, I'm okay with the LO making I would actually take and increase my LO. I would take my costs and move them variable to the LO and eliminate my fixed costs, because it's the fixed cost that's killing them. If you're only doing one loan, I'm paying you $1.25, on your one loan. Okay. But if I have a lease and all these other people, generally relatives, who come with you, it just doesn't work.
Well, that's kind of like in that branch, though, saying to the loan officer, okay, let me pay you too, and you pay all the costs in your commission.
Except you still have all those costs.
And I
have all those costs, right? Because I've signed a lease. I mean, when I was at Finance of America, I probably got out of 500 leases.
Wow.
500. I mean, I basically had an estoppel certificate about every 5 minutes of something that somebody had, so I actually think the challenge with the industry is that the LO doesn't do as much in retention as they probably should, and they lose the customer through the origination and what I'm going to call the dumping or the sale of the servicing. So they don't really own the customer anymore. They try. So that's a problem. And then on the flip side, I think you've added 20 people to, it's like the old joke of how many people does it take I was going to say how many lawyers, I'll use my own industry. How many lawyers does it take to actually screw in a light bulb, right? 20. One to actually hold the light bulb and 19 to turn the ladder, right? Yeah. So when you look at it, I think that's a challenge for us. I don't know, to grow, everybody wants to take the branch and move it so they become more mercenary-like than they do become actual owners and wear the colors of the companies that they work for, which is, I think the other piece is loyalty.
Can you speak, Bill, to more of the digital channel and keeping the loan officer concept, but more in a home office environment rather than the cajillion leases?
Yeah, I think one of the things that we did was we assume that, like I call what I think is legal. I think you can call yourself a home equity advisor or a home advisor if you want. And almost every top loan officer that I've ever met sees themselves as creating customers for life. And yet they act, while they talk relationally, they act transactionally more than ever. So, and because we pay them all based upon just the transaction, why wouldn't you? So what we tried to do was have two different comp plans for LOs. And one was for a refi and one was for their standard business. But one was for the retention, I guess, of the customer, and one wasn't, because we thought we could centralize it and try to move it into a call center format, but then it's sort of cold and callous to the existing customer and not fair to the LO. So one of the things that we did was we just had loan officers opt in to a second structure with a much lower comp plan, and that seemed to work. And then we, in each branch, converted, which is the secret sauce, is we converted an LOA to what we called a retention specialist. And in each of these branches, we then were able to manage the LOAs to actually do a couple things. So at the closing of a transaction, we called it an opening, and the retention specialist would, on behalf of the company and on behalf of the LO, call the client, congratulate them, thank them for the loan, ask them for a referral or two, clean up any problems that they had, and they had many, right? They would say, oh my God, my servicing didn't transfer, or this didn't happen, or whatever, and give that feedback back to the LO. And we do it on behalf of the LO. We call the employers on both sides of the transaction and try to sign them up in what we call our Home Benefit IQ program, which was basically signing up employers to put our product and services into their employee benefit plan for free, right? So it was a little bit of prospecting at the same time. But now I've taken an LOA who basically was used to maybe picking up coffee or going over and getting somebody's dry cleaning, and turning them into somebody that actually is doing something that I can manage. And it worked.
Well, I think several companies, certainly I give credit to Movement Mortgage, who has really taken that concept of upfront underwriting, having your LOA do a whole lot more. I think, and I may be wrong, but I think they do a lot of the work, the paperwork,
They have to be managed, but heck, Chrissi, I mean, come on, you're doing 2 loans a month.
Yeah. How hard is that?
I mean, I don't need if you were doing 22 loans a month,
Right.
when I was full throttle back in the day, I was doing 50 loans a month.
Right? And my average loan size was 85,000. And what was your?
I didn't have you didn't either. You probably had a processor because it was your company or something else, right? But I didn't have an LOA. I talked to my clients. I did all the things. I put the stupid thing in the system. And like you, I waited on that freaking credit report to come back. Scared the shit out of me. And it cost, how much your credit report cost? $200. Cost a fortune. So it's almost getting back to that level today.
Did you find back then, I hear a lot, loan officers worked with the buyer to come up with the best program, and now loan officers are working to try and get them qualified in DU or
Michael,
qualified
one
in LP.
program. There's one product.
Yeah.
A 30-year fix.
Right.
It's boring. There's nothing to do. Back then, there were a shitload of products.
Oh, Bill, you know what? We're sounding like those parents that had to walk 10 miles to school and the stuff.
True. I had ARMs. We had ARMs. Nobody understood an interest-only loan. Nobody understood whether you were doing a 5-year, a 3-year, what was your adjustment rate? What was the adjustment? And every time interest rates changed in my career, when you had adjustable rate mortgages, right, you went on a binge to explain how the stupid thing worked. Nobody understood them. So now you circle post Dodd-Frank and post 2003, 4, 5, 6, 7, and 8, when the world sort of changed, we came out of that with vanilla, 30-year, one comp plan, one thing, right? So, and the only thing that saved the industry at all is that interest rates plummeted over a period of time. Right. But yeah, I mean, we talked a lot about 2 things, Michael. One was the product, because you had to basically explain the difference between a fixed, which was much higher than an ARM, and what type of ARM. And then at the same time, I tried to convert every one of my clients contractually to sign an agreement that made them I was their counselor for life. And it worked.
I've never heard that. Get an originator to sign an agreement with a client as a customer for life. I mean, I know it's not enforceable, but it's
because you're not a lawyer.
Yeah, I mean,
yeah, because
it's an amazing document to protect.
Well, why would you not, right? So if I'm meeting a client today and I'm a loan officer, I have zero idea whether that client is mine. None. And with the amount of disloyalty that's available to people and the amount of information that's free flowing in terms of rates and everything else, you find that we've lost control of our referral source and we've lost control of our client. So why are you doing this? So what I did was when I met with a client, I just said, look, I am your home equity advisor. I'm your real estate person. I want you. And so what I would do is I had this agreement that basically said it was my commitment to them, really. 10 SLAs. This is just exactly what I'll do. This is what you can expect from me. And the reason I did it was because anybody who was viewed a professional in my world was either, an accountant, a CPA, even contractors, for crying sake. Everybody has you sign an engagement or some agreement to commit to do things, except in car sales and in mortgage. Even realtors, when they get a listing, sign you up. Why are we not doing it? I don't know. So I did it. This was years ago. I've just never really understood why you want to do a lot of work without knowing you have a client or not. And I want them coming back to me. So I've spent a lot of time saying, okay, the deal starts when you buy the house. And that's when you and I start working, because I want you to pay it more. I want you to pay it differently. I want to stay connected. I want you to grow your equity. I want to be your home equity advisor and help you not just have all your net worth and all of your life savings in a home. You need to be able to use your home effectively to build wealth. That's my job. And I like that job a lot better than, always ferreting a new customer. And the problem with Dodd-Frank and the problem with everything else is we don't pay LOs to stay connected, and we don't pay them to help service the loan properly. And at First Franklin, I serviced everything. So our clients immediately went into the servicing pen, and my goal was never lose one when they came back. And so, and you look at the difference today, it's just a massively different. We're sort of an origination and dump industry, which doesn't bode well for compensation, because people do what they're compensated to do. And unfortunately, we're compensating them to be attention deficit and just get a deal done and then go on to the next one.
I loved your idea of the retention customer, the
Specialist.
Yeah. That's very clever. Now, wow, so that could play very well into your sign here on the dotted line and you're now my customer for life. What was it that you would offer them that sounded attractive enough that they would be willing to sign that and to think that that was such a hot idea for them?
Well,
love it.
Yeah. So a couple. One. So today, which is really funny, you sign every time you download an app. Do you read any of that shit? No,
just click with my thumb.
You just click a button, and what's it say? Terms and agree. And so part of what you could do with FinLocker, or you could do with any of those, is add your SLAs into that, because people just click on it anyway. But in the home advisor agreement, right, I basically, there's 10, what I call the 10 commandments, really. And those commandments are, so if you think about it, the agreement basically says, my home advisor services, agreement and commitments. And then it says, as the client wishes to obtain the professional services of the service provider, and I'm a service advisor with knowledge, skill, and capability to perform home equity services for the client, therefore, I'm going to provide these things. I say the nature of the relationship, it's very simple. Could be a financial component if you wanted to create an annuity. But my view of it is it's somewhat like Fisher Investments today, where if you do well, I do well.
Yeah.
Right? I get paid when you get paid. The term of the agreement could be, I always tried to do it for a year, but cancelable at any time. It was very simple, right? And it just between. And then I said, here are the 10 commitments. If you guys want me to go through them, I will. But today, monitor and improve your client's health. Always act in the client's best interest. Keep your client's information safe and secure. Help client make informed financial decisions. Establish a disciplined plan to help the client better understand their spending and how they can save more money and reduce their debt. Provide educational resources so the clients can fully understand financial products and services. Deliver best-in-class loan product offerings. Help the clients understand payment options available so they can maximize their home equity. Coordinate financial professionals to assist customers with planning, tax planning, insurance services, and other important advice. Basically, become the client's single point of contact and keeper of these commitments. Their home advisor. Done. Drop mic. Go.
That was fantastic. I'm glad this is recorded so we could go back and write them all down.
Sure.
Hey, I just think this is like Dorothy, click your heel. You can go to Kansas. This isn't like it's hidden. Why are you not doing it?
Yeah, well, we do have technology that just help us. For instance, BMA has collateral underwriting. And, that does help us move into other markets. It's true. I need to keep that in mind. That we do have additional support.
Now, the reason I think lenders, well, look, I like things to be contractual. I like making commitments to other people. I like keeping my commitments. I like making sure that the client knows that just buying the home means nothing, right? It's a good start, but this baby will either be an anchor or it will be a sail, and you will either take off or sink, depending upon how we help you manage this for life. That is my job, in my view. The challenge with Dodd-Frank is that they think we only should get paid upon the closing of a transaction, and we should all, because it's one product, get paid the same amount. That is a travesty.
Well, it's really bad when back in those other days, if the loan officer did make just a horrible mistake, at least we could let him steer in that loss. And now, obviously, we can't.
So even concessions, Chris. I mean, you've taken on you own a company, run it right. We now have all the concessions and extensions. We take all the risk.
Yeah.
And I think one of the biggest issues in mortgage is on the front end of all this stuff that we're talking about, we just do it poorly. On the back end, we sell the servicing, we use a subservicer, the customer is in never, never land, and you saw that with forbearance, where the customer didn't even know where to go, and we couldn't help them, right? We could influence things. And so I think what movement, Casey's done an extraordinary job. One of the things that he's done that I just think is phenomenal is on the other side is they allow the loan officers to own part of the servicing. And so they can invest too. Now, how they do it is tough because you got to manage, Dodd-Frank and everything else in terms of how they get paid. But I think, I run a private school in California called Oaks Christian. And one of the things that we have to provide a lot of aid because it's expensive. It's an expensive school, but to have a balanced, student body and to have things that really matter to be able to provide them to parents is we have to provide aid. We believe that people who have skin in the game, some skin. So everybody that comes to Oak has to have some investment to their kids' education. We'll pay for some of it, all of it, depending upon their financial need or want, but we believe in and the number one family person that we commit to generally is about a third of our aid, not a third, maybe a fifth of our aid goes to the parents who are teachers and their children.
Right.
And we want them to have skin in the game as well. Why? Because people pay and act different when they own it. In fact, my second company was named Own It, and that's because you don't lease it, you don't do anything with it. You have to own it. And when you look at, times and just the way things, that was probably one of the best businesses that I was ever a part of. And we didn't sell one loan to the federal government for probably 10 years. It's through First Franklin and Own It. So I think
that was one of your better business decisions in a boardroom ever, right? Like selling that at the right time. And it kind of goes
to close the company. I mean, look, like Chrissi said, it was when we created the product, the 100% loan, it was an 80-20. It was an interesting product because, and in fact, in 2003, with interest rates about where they are today, the industry did $4 trillion of it. So what was the problem with it? The problem we always knew was that you have to fully document these loans.
Yeah. And
they don't. Now, we use what we called alternative documentation, which today I think is far better than the bullshit that we do in what I'm going to call the agency business, because I think I want to see tax returns. I want to see income statements. I want to see if I'm going to look at a P&L, I want to actually see the money coming in and out of your checking account. And the challenge was that as that product grew over, because when we first started, it was 96 or 97. By the time the industry sort of blew it up, it was in the early 2000s. And suddenly we're doing 90, 100% LTVs. We're on refis. We had the 125 loan that was out there. It was like, what? And then people were just, fogging a mirror. Just suddenly you're doing a stated loan. Well, that's not, we all know you don't do stated loans. Then why were we doing them?
Well, the agencies really said, oh, yeah, you can state it, but I hope you're not wrong, because if delayed defaults, you're going to have to prove that you were absolutely accepted through.
I remember working with RFC and MGIC.
Yeah.
Think about that. You had MGIC and RFC, two pretty big dogs.
Yeah.
What was the product that they rolled out? It was called Easy Docs.
Yeah.
And Easy Docs was at 70 LTV, not 100, right? You got to have equity, skin in the game. And the one thing that I think 2005, 6, 7, and 8 taught the world is that I don't care what happens in America, 92% of the people pay. This whole thing was about 8%. The unfortunate thing is that 8% all went to foreclosure.
It was if your credit score was what the model was for like the fast and easies, or what we called the quick and simples. If you had over 700 credit scores, the agencies had told us 97.5% of the people always pay when their credit score is over 700. Well, that's true until they have no equity and they owe more than their house is worth. So,
well, and ours was a little bit more so LP, DU, but clearly LP, or now LAS, was built around a score. Score is the best predictor of default, but you have to add LTV to it in order to figure out the risk, because one is default risk, the other is severity. How much am I going to lose? What is the likelihood that I'm going to default? The interesting thing about all of that is that income has never been correlative to default. So DTI really has very little to do with default, because you default when you lose your job. Now what's your DTI? So what's interesting about all the work we do is we get so laser focused on whether we're 43, 48, 35, whatever the DTI is. And yet, I would be best, probably since you and I have been in this business, it just so happens that no matter what that was, because I think when I started, it was 18-25 or something like that, my front end ratio and my back end total housing debt, I think everything sort of came in like that. But what we should have been doing was spending time trying to figure out what is the likelihood that this client will pay, and do they have any assets that are left over, right, to help.
Yeah.
And if you look today, I mean, we have historic amounts of home equity and nobody taking it out yet. And I think the big opportunity for us lenders is that.
If I can just interject, though, David Battany, who's on Resborg now with you, Chrissi, and over at Guild Mortgage on Capital Markets, he did a great presentation at Digital Mortgage where they analyzed 5,000 of their loans, and they found that DTI was the worst indicator of default. And the best was actually cash flow on bank statements when single source data was revealed.
Well,
David was our partner at Fannie Mae before he was at Guild.
Fan of his model. And certainly when I was chair of Resbog, David was a big participant. Now he's co-chair of Resbog. But he has a fantastic model, and he really cares about affordable housing initiatives, does Guild. One thing that I love about his model is it doesn't penalize Hispanics, for instance, who might very well keep their money at home, or they may have 10 relatives that are helping support the household.
And I would say that my view of it is it's a bigger issue, right? So used to be the whole agency industry is built upon a primary occupant, single family, owner occupied, generally one borrower underwrite. And the challenge is none of our deals look like that. And so my view of why you need to be in other products and other services is, and I still don't get it with lenders. We have one product, a 30-year fixed rate loan, and 500 sets of complicated underwriting guidelines. And we have, no wonder underwriters are doing 2 loans a day, right? It doesn't make any sense. If you want to manage this, you have to reduce the complexity of all these other guidelines and rules. And you've got to create a uniform set of guidelines for your company that encompasses a loan, because a loan's a loan. I don't care whether it's I don't look at a customer shows up on my door. I don't call them, not QM. Are you QM? Are you subprime? Are you prime? Are you an agency? We know all these things, but your client is either one of 2 clients. And I have this huge study that we did years ago coming out of California. And it's really interesting because I think we call people underserved. We have people of color. We've got all these things. And basically the industry really doesn't care. And you need to make sure that you're doing it transparently through race, color, creed, religion, national origin. You don't favor one for the other, but you do it properly. And so when we did this analysis, we had 2 customers. We had an MNA, a mass non-affluent, and an affluent. And we defined it. And we said, if you're under $100,000 in income and you're under $100,000 in assets, you are what? MNA, mass non-affluent. And if you are an A, you had over those numbers. And we had 2 sets of guidelines and rules, and we tried to give people income so they qualified, right? Because people have all kinds of side hustles and other stupid things they do to make money, and we can't count any of them. But what we can do is count all your freaking obligations. We're professional obligation finders in mortgage. And then we analyze it to try to get you to a precise DTI. And that's just about as successful as trying to figure out exactly what a home is worth, or what the home price is.
Yeah.
Because homes aren't priced to the dollar. They're within a range. And yet we focus on, is it $5 or is it $5.05? So I think you've got some structural things this, and let's just go to the single family residence. The industry is no longer an owner-occupied, single-family, primary occupant, primary score business. 40% of the volume today is other than that. So it's not owner-occupied, second home. Who the hell knows where you're living home, right? Because and then your house is mixed use, because your single-family home suddenly is not only your owner-occupied residence, but you office in it and you rent it sometimes. So you get income from it. And the best income I think you could ever count for a person is that income, because that will survive your job. That will survive your death. That is there no matter what, not your job. So I don't know about you, but there's a lot to do.
Bill, can you touch on too, and see if you agree with me, that certainly one way that we can avoid not just mortgage fraud, but maybe streamline our processes to use that direct source data, similar to what David Badney was talking about with the assets, the bank statement. Use that to analyze it. There's a lot of AI that can do that. But the same with the W-2 and pay stub. Let's not take the risk of asking the borrower to provide that. And also, we want our borrowers to have the best experience, and for them not to have to go rummaging through their folders. Just get it ourselves. And then
it's hard. It's very, you're right. But it's very hard because a lot of the income from most of these folks, a lot of it is in a side hustle that's documented. It's either new, inconsistent, or it's something that we don't count anyway. And so,
but I would think on it anyway as a lender. It would steer.
Well, I don't know. I mean, like the most interesting thing when we built Cloud Virga, a point of sale technology. The first thing that we struggled with was co-borrowers and keeping. So the whole industry wasn't even built on co-borrowers, right? We had a spouse, and you sort of knew there was a primary earner, and everybody was employed. Well, so today I have a lot of my clients are employed and self-employed at the same time. Okay, now what do I do with that?
Yeah, the gig economy now is up to 80 million people are on Instacart, Upwork, etc. And
you are, Michael, you are the guy. Right, fractional CRO, you got a podcast, you got a bunch of side hustles, and I bet you when you try to document this shit, you don't have a W-2.
Right. Yeah.
I would bet on
digital stuff.
I would bet on you far more than I would bet on somebody who's working at a technology firm other than NVIDIA or anything to do with AI. Because everybody else is getting laid off in some facet or changed. So I think self-employed customers get a bad rap. I think, and the challenge that we're getting today is that a self-employed client, in some cases, most families, and maybe I'm wrong here, so correct me, you guys, if you think I am, but I think most clients have especially if you are partnering or you're married in some way, shape, or form, you have somebody doing a side hustle and doing something that is sort of giggish, and another person trying to get benefits who's employed. Seems to be that's an interesting model that we never really...
Here's the biggest part, and I do want you to make your comment, Chrissi, but I just want to say we're now on year 16 of this, right? At some point, we're going to disenfranchise the self-employed to even apply because it's going to get long enough where they're just so frustrated or the gig, we lost them.
Or the Bolsheviks revolt, the clients revolt, and they basically say, and somebody big provides financing that looks more like an open door or something else and a little bit less like an IMB. That goes to the agency. Because if you want, and let me give you a great example of that today. These HEI contracts, these home equity contracts, these are not even loans. And you have 5 big companies doing lots of these. And you want to know where some of your cash out is going? Probably the fastest growing, most misunderstood thing in mortgage. And mortgage bankers aren't doing any of it because they don't understand anything that's not a loan that goes in the agency.
My comment was going to be, Bill, I agree with you 100%. There, especially in this environment, there are so many ways of entrepreneurship to be able to create their own wealth and their own business model. And I'm good with that. Even, put it on your taxes, disclose it, and give me a 2-year history. And by golly, I don't care what do you think about that?
I love it. I mean, it's the world I created a long time ago. But I didn't do it. I mean, Beneficial Finance did it a long time ago. I mean, I would take my client, my tough client, I'd take over to my friend at Beneficial and I'd broker the loan to Joe Pedowick, and Joe would look at his tax returns and say, here's a loan.
Did you have to walk with your shoes tied in the snow?
Yeah, we didn't. I actually took
a car over to see him.
Yeah, I took a car. Can you believe that? I mean, an actual one that had gas in it, that actually freaking runs in any market, no matter what.
With your snow chain.
Yeah. I mean, so I think when you think about it, nothing's changed in mortgage. It's a little bit like my approach with Oaks Christian. Is it really the way that we are going to educate people, is have a teacher stand in front of the room and dictate something after you've read a book? No, that's not how information is flowing, and that's not how people are learning. So how can we innovate education? How do we provide an experience that helps students learn? The same thing's true in lending. There are many, you guys are talking about how many different types there's personal loans, there's peer-to-peer loans, there's hard money loans, there's what Civic does, right? Now you're doing non-owner occupied loans. You've got commercial loans, you got mixed use, you got all these different components, and it's actually fitting better. Because the other thing that mortgage suffers is the business was not built for cash out. The business was built for the government to provide lending and you to have no cash.
Yeah, that's the problem. Now everybody has equity. The loan officers are
wants it.
It's almost like the loan officers need a new title, like you said, equity advisor, or like, what do you want to be? If you're only selling first mortgages, and what is it, 88% of them, according to Moody's, wouldn't touch it until their hands are cold. So I guess HELOCs have become more correspondent now, but like in 94, Bill, when you had the merchant banking transaction, you sold your business to, I think, the Founders
ELJ.
Stock Exchange, ELJ.
Yeah.
You said the interest rates went up 7 times, but it seems like you hinted like people didn't have equity in their homes like they do today. This is a little different, but no one's touching it. So is that just the industry we're in?
Opportunity. I think it's the biggest opportunity in America for LOs today. And I think you just have to be reasoned, and we have very limited. So if you're a mortgage person, the first thing you talk about, I'm going to go how I think about it, right? So I think cash out is a big opportunity. And most mortgage companies aren't set up for cash out as a separate product. So cash out starts with a refinance of the first. Not going to happen. They all have 3% first or whatever. Some people are going to, but that's where it starts. It then moves to a closed-end second, because that is a QM loan, right? And that rate's what? 10 to 12. No, I don't want that either. Then I move to a HELOC. Now it's sort of bankish, right? You got Figure, you got Spring EQ, you got Symmetry, and a few others guzzling around trying to offer a HELOC. And, oh, by the way, a lot of the clients have been at PTSD because they had HELOCs in 06 that they couldn't advance because they shut it down. So HELOC, and then you move past HELOC and you go, if you're over 62, you might try reverse, and then you've got cash out. So I think the number one thing that people are missing is, I don't want a payment. I mean, if you don't have a payment, your only option really is either a reverse or these home equity sharing agreements. In either case, I want to take cash out with no payment. That's a better strategy than, hey, give me a 8 to 12% loan or something, right? So I think when you think about cash out, you have to have a full panoply of products, and you've got to have a full panoply of products for non-owned and second home and mixed use, because every property in America is becoming that. I mean, I'm either watching CNBC, the Golf Channel, or HGTV. Those are my 3 options here at the house. And everybody's a flipper. Everybody's buying something for investment. The thing that's changed most in America is the use of the single-family residence. So I'm excited about it because I think this is the time, because you have more tappable equity than the history. So you don't have a credit bubble at all. You don't have a property bubble. Now we got major problems throughout the world, and I think interest rates could, although maybe not, go down. Just have to be careful there. I mean, I think you watch it, it wants to go down. If people want to talk about it, if you watch CNBC and just finished, you watched really the Fed JP get crucified again by everybody about why is he not dropping interest rate.
Yeah, and I think from an image standpoint too, this is just one piece that I know we're way over time here, so I'll one quick part.
To do that.
I mean, we got 2 legends on here. You always get a little bit insecure. You're taking up too much of their time. But here's the 2 points I did want to talk to you about. So I'll wrap it all up here. But it's so raw, we're actually doing exactly what the podcast is supposed to. Even if the consumer doesn't want that product waterfall you just went through, to me, the branding of the loan officer now has a reason to reach out throughout the year. Don't forget, any consumer that might be self-employed, has credit card debt that just went up to 34%, doesn't mind talking about possible ways to get out of that. And otherwise, I think these lenders have to ask themselves, they're doing all this hard work, and when they look at the balance sheet, you kind of point out, unless you're retaining servicing, you don't really have as many assets as you think. You talk about leases, liabilities, and loan officers. People are really the asset. Can you just talk about that too? I said it earlier in the show, I don't know if you were here, but you talked about how Chris, George, and Victor were brokers working with you at one point. Now they run top 20 IMBs, and who's the next broker out there that could run those? On their journey, would you give any advice to them? Like, don't get ahead of yourself. The assets you think you have are different than they are.
Yes, I agree with you. It's a great segue, right? I think my view of this is that when you're building a business, whether it's you guys on a podcast or Chrissi in her business, you're trying to build something that's valuable. The first thing that I've learned through buying and selling my business back and everything else is that the P&L is really people and leadership, not so much profit and loss. So the people are important, and leading people, being transparent to them and being smart with them and helping them grow their business is what you do. The second piece that really is the challenge for mortgage bankers is what asset are you creating? Well, like I said, if you're not retaining servicing or you're not retaining the customer relationship in a contractual way that I just gave you, then you are basically building leases, liabilities, and loan officers, and nobody wants that. Nobody wants a bunch of branches all over the United States with a bunch of people that look more like the Wagner people who are turned on Russia than they do on a person that works for Chrissi.
Yeah.
Bleeds, Knoxville breeds an odd orange color and white.
No.
Go Vols, right? It's like, so, and oh, by the way, Chrissi, my two quarterback coaches and who helped me grow football at Oaks Christian, both were quarterbacks for the University of Tennessee. I think you can create assets. So let's say you're not going to retain servicing, which most can't afford to. What you can create is you can go. So if I were going to sell my business today, I would say to the buyer, how long you been in business, Chrissi?
34 years.
I've been in business 35 years.
Wait. I've got
350,000 customers under contract. I have agreements with most of these clients that I'm their home equity advisor. I think that has value.
It has huge value.
The way we sell it today is there isn't a deal I haven't looked at that doesn't say I have X number of employees, I have Y number of branches, I have Z number of this. Yeah. I'm breaking even or losing money, and I have no service. And you know where those companies end up? They end up at Gill. Right? Because who else would want these companies other than somebody who's already in the business, right? Because it's very tough. So I think, and I've been successful in selling my businesses because they all have assets and they make money. But I have to tell them the first thing that they don't understand is they do not understand that in the mortgage business, it's very cultural, and you have to really be a good cultural leader. And you keep first things first, and that the and that's what I've always said, the P&L are always people in leadership and making sure that your people trust you, right? Over 35 years, people trust you and they believe in you. And you're good at what you do, right? Those are all things. And if you looked at the mortgage, Chris George, Casey, you take Dan Gilbert, you take Matt Ishba, you take people, all these people brokered loans to us. You take the current group, so whether it's Eddie or you take the PRMG team or you take, all these people build companies. Most of them are built around the cultural leadership of a independent mortgage banker leader. And my view of that has always been, I think you evolve over time in terms of your leadership skills, your ability to understand the strategy that you have to convey. And so what I try to do with clients is I try to help the leader understand how to run a good business, how to become a sustained leader that people can believe in, how to convey that to your troops all the time, and then how to build something that has eventually becomes the asset of envy because other people can't build it for whatever reason. And I consult with people to try to help them. And even when I ran my business, it was basically, how do I grow up 20 people who I started, who went to school with me at Santa Clara in law school or went to college? How do you grow those people or help them grow? Michael and I sort of meet. There isn't a person that doesn't call me that I don't call them back and spend time with them. Why? Because they called me. They needed help. They wanted something, right? Our job is to help other people.
Of the people that need help, Bill, there seems to be this trend now of the 40, let's say, people that did a little bit more than 2.5 billion up to about 7 in 2021, 2020, must be struggling with something that makes up scaling to mega scale. I don't know if it's middle management, too many vendors. Are we going to lose that kind of middle class? Like you're either going to go to 2 billion or you're going to be one of these top 20s from this point forward?
I think March will tell, right? You watch what happens, right? This has been a long slog for mortgage bankers. I don't think I've been in the business a long time, and I've only seen a couple of these where you've had 2 or 3 years of prolonged losses or spending of money that the middleware hasn't just been obliterated. So I think time will tell because I think there's a lot of the number one strategy of hope or prayer that interest rates drop. And I'm not so sure they will, at least at a level that will sustain a 25% refinance market out of our home market. So I think there are a lot of structural issues that even if it does, that group probably needs to get a lot better, not bigger right now.
I agree 100%.
And I think Chrissi's a great example of a company that sticks to like she said, and she was honest, right? It's hard to grow what she has. And what's funny is she really doesn't want to. She doesn't want to get out of control. Right. And it's hard to find people to come aboard. So when I talk to a lot of these folks in IMBs, they're trying to produce their way out of it, and that will not work. The first thing I tell executives is $1 of new production is worth maybe 10 cents. And if you're losing money, it may be worth negative 10 cents. $1 of fixed cost savings is $1. Lower your fixed costs to right size your firm to where you are. And like you guys had said, this $2 to $7 billion group before in 2017 and 18 was probably $1 billion group. So they've now gone back to their roots. They're now $1 billion group with fixed costs at $7 billion. So they've got to really go back. And then, okay, if you look at where we are today, I mean, this is my Gretzky quote, my neighbor, Wayne, and it was always the same, right? Where is the puck going to be when you look out in the end of 24 and 25? And so, and you have to sort of build your organization to lower your fixed costs and then strategically get yourself in a position so that you can take advantage of what might happen. Now, and the unfortunate thing is it might not happen as well. So you just have to be edgy and cagey. And I think that's sort of I guess that's the good news is that most of these independent mortgage bankers are what I would call grinders.
Or grit, you always say, right? They have grit.
They have grit, and they've read the book, and they've lived it. I mean, it's unbelievable the amount of pain that a mortgage banker can live with. And they do it, almost as a second nature once they've been at it. So in my view of, if you're going to build an organization, you have to, so I always use the book, and I don't know if you all are readers or not. And I help people look as they're going through it. I have them look at Scaling Up, and I have them read it and spend time. It's Vern Hardish's book. I don't make any money on it. I mean, I'm not selling my own stupid book, right? It's like this book is all about how to scale up your organization, and you have to lay a foundation that enables you to do it. The people, in my view, who actually do this well are grinders. And they are people that can take a lot of pain, but they focus on the 4 quadrants in scaling up: people, strategy, execution, and cash. And you cannot run a mortgage business without cash. And production is not cash. And you know what the one thing is really wrong with the business is derivative locks are not fucking cash. Right?
No, they're not.
Cash is when you what, Chrissy? When the loan closes
Yeah.
and it sells to the investor, and I get the money without a repurchase request.
You know, we've been in business for 34 years, speaking of the cash, and we've always retained our earnings. And so we have we have a lot of very high net worth.
Big book
In cash.
Yeah. You don't have cash.
No, we have cash. We have some.
Yeah.
Yeah, no.
But it's not. It's not like once your book value becomes book value. It's like a history lesson.
Yeah.
We've proven that we can make cash.
Yeah, but it's important that we do, because we didn't make any money in 22. It was like the investors are saying, or we're out like, so. But I go, well, look at our balance sheet. Oh, okay,
Yeah, that's good.
great, because we had cash.
Well, and it's like
my people for, when things turn around at some point in 24.
And what if fast growing things suck out of a business? Cash.
Yeah,
It eats cash. In fact, the guy that used to help me, Jerry Faust, who I met at like an MBA president's conference as a speaker once, and Jerry, who just recently passed, Jerry basically said his view was there's a big fan. There's 2 fans. One fan is sucking it. The other fan is blowing it, but it's taking your cash. And I think, so what I try to take to people who are really not disciplined, probably my best personal trait is that I'm very disciplined. I'm disciplined in what I eat. I'm disciplined in my religious faith. I'm disciplined with my family. You can depend on me. I mean, I'm like that old car, right? I just keep running. But I think disciplined people, disciplined thought, and disciplined action differentiates successful businesses from others. And I don't care personally what the size is. I don't care how much volume you do, because people always come up and say, can you help me? But I'm not doing that much volume. Well, good, because all these other companies had a lot of volume and now they're shrinking. Let's figure out how you can build an organization that focuses on people, strategy, execution, and cash. And yet, if you don't have great, like Chrissi knows, I mean, if you don't have access to cash and great access to cash, you haven't lived, right? And I think what's cool about mortgage bankers is that they've lived in this gritty business where I've got to be able to convert production to numbers that make some sense. I got to sell loans. They've got to pay. I've got to have operations. I've got to have teams that are somewhat disconnected. And the number one thing I've learned over all this time is that it's people that deliver it. And if they trust you and they believe in you, because what I don't want is I don't want one of my people taking one of my clients down a bad path, ever.
Especially if it's because you weren't disciplined, right? And forgot to call up, forgot to follow up, or as a leader, got away from training.
That bad. I mean, like I've always said to some of my clients, don't borrow. No. It's like my kids. Sometimes it's just no. And I think we have a tendency to want to do production or loans when you probably should say to a person, you need to You need to basically reduce debt. And the only way you're going to do that is to quit doing this and pay it off. I mean, it was like the guy the other day that said he took all of his subscriptions and paid them off and bought a Tesla. I went, well, why didn't you take off all those? My view of that was everybody thought that was great. I said, I would have taken all those subscriptions and paid them off and bought a house. Something goes up in value.
Bought today's newspaper with it, right?
Yeah.
I mean, we always quote my father, who always says, Harry Houdini always said, leave the audience wanting more. I think our assignment now is to read Scale Up.
Yep.
And then ping you again and try and get you back on here and kind of take that as the next piece and maybe after March see where we can provide some scaling up advice to those, because the market will turn around. And if it isn't, and they listen to this, they should be in even better shape, right?
No.
I mean,
I appreciate it. And Chrissi, I appreciate you. And I've admired your business for a long time. And I think sometimes, Chrissi, scaling up is, I told people when I had First Franklin and we were like 50th in America, and I put a time frame, and I said, we're going to become probably top number 1 or 2 lender, independent mortgage bank in America by this date. But my strategy was that the other 48 were going to fall. And I want to become number 2, not by outproducing 50 people, because I'm not going to be able to do that. And I think you're well on your way, young lady.
Well, I've seen certainly a lot of people through the years that were my competition that just don't exist anymore in these last 34 years. So you're right. And I think that was, a great mindset to have back then or anytime.
2 Michaels, thank you guys for today. Appreciate it.
I mean, this is really in theme with what we do, which is raw. The fact that you two spoke, I can't remember a last time 2 IMBs really spoke on a podcast. It's always some vendor like myself interviewing somebody else, or maybe
instead of Chrissi interviewing Bill.
I think people loved it. It was really raw. It was great. Appreciate your time, and thank you both. And thank you everybody in the audience for sticking around here.
Bill, thank you.
You too. Good catching up, Chrissi.